I see Mike, and there I am. Okay, hello and welcome everybody to another episode of the Swing Trader Status Update. It's Justin Nielsen, your host, and I am joined as usual by Mike Webster, our senior market strategist. And today is November 19th, 2024, and it was quite a day in the market. We had a nice day of outperformance. We've got a lot of heat that's working, and we went a little aggressive today, and we're going to discuss some of the reasons why. Last week when we were talking about what a difference the week made, but then at the end of the week last week, we kind of ran into a little bit of trouble. But if any of you watched our stock market today video on Friday that Mike and I did, you'll know that basically we were saying we were at an inflection point. In fact, we were talking about regression channel lines of how this was the spot that we really wanted to get support. And Mike, I'd say that the market delivered.
At this point in time is picture perfect. Like it was exactly what we wanted it to look like. It's done everything it should do. If you recall, after we had the gap up post election, we were saying that at some point we were going to get a nasty sell off. I really, frankly, thought it wasn't going to happen for a couple weeks, but it was set up that last Thursday, where your expectation was some weakness, but that weakness really kind of got out of hand on Friday. You had that really big gap down, closing underneath, just slightly underneath your 21 day, but it was still a break of the 21 day, and that is a real thing, and you need to take that seriously, especially when you're swing trading, but even position trading. But we were saying that as we were moving up prior to that the down move, was the market was going to be tested at some point. It was really about the reaction to the test, because there's two sides to the market. There's bulls and there's bears, and most of us always think in terms of bulls, but you always want to put your bear hat on. And if you were a bear post election gap up and things were holding in there tight, what would you do? The first sign of any weakness, you would use as much ammo as possible to try to get that market to break down to its 50-day and really break below that. And that was in the cards. If the Bears were able to spend enough ammo and the market was really weak enough, we would have gotten there. But that was what the test was about. And this is a huge poker game. It was just a big test, and the Bulls won, and it did exactly what it should do. It stopped where it should. Now we're back above our 21 day in a material way, way more than we had ever been below it. And let's look at SPY for a second, which looks even better in some ways, because that one just barely got down to it's slow. It was just like a hair underneath the 21 day, and now you have the nice upside reversal. And the expectation is it's a magnet to 600. Now, I was told that there's a big company, I can't remember the name, that's reporting tomorrow after the close, just to try to make things very tricky. Is there something reporting?
Yeah, it's funny. Luckily, I was looking at Tim's comment in YouTube there. Tim, of course, we met in Las Vegas for the Founders
Oh,
Club meeting. So Tim was
okay.
saying, interesting that you guys went aggressive in front of this risk event, with NVIDIA. And by the way, this is something that I actually just talked about with Joe Fahmy, who was also in Vegas at that Founders Club event on the podcast this past week. And he was, kind of mentioning, hey, look, sometimes you will have these risk events, and you can almost always find a reason to not be aggressive, but sometimes it's best to kind of lean on the charts and say, okay, this is what the chart is telling me to do. Maybe I should just listen to it.
Yeah. So for a general market, I agree with Joe. Sometimes it's tricky though, and it just depends on how you're doing
Mhm.
and what type of setups are there. Sometimes into risk events, you've got to back away, and I've had to do that, um, just because it really is. There's so many moving parts involved with that. But right now, the market looks completely set up. Now, in the post Reg FD world, you have gap ups and you have gap downs, because the prior to the Reg FD, all the information was really kind of leaked out there. It was just a dirty little secret. The information was out there, and Bill would always say, Bill O'Neill, founder of IBD, would always say it's everything is in the chart because it was, and that was the way it was from 1880 until Reg FD, whenever that was, like 15 years ago, plus or minus. And then
Oh, it's over 20 now, I
what was
think.
it? Oh God.
Yeah.
Oh my God, we're getting old.
Yeah.
It feels like yesterday. But anyways, what happens now is no everyone gets information at the same time. So you get these big gap ups and big gap downs. Now Nvidia is so important to this market that
And we both, just real quick, we both do have a
oh,
position in this, so we need to disclose that. So, yeah, please continue.
sorry. Yeah. Yeah, of course. Yeah, we both have positions there. So going into that, I mean, this looks like a perfect setup. You have this little shelf with a shakeout underneath your 21 day, regaining that today. Now, right
In a big
underneath,
way, almost 5%
yeah,
gain today.
that is a big gain, and it looks like it wants to break out above the 150. Now, of course, it's going to be, what the CEO says on the call, really more than their earnings, and the whole Blackwell thing. And without getting into the weeds, it's about the reaction, not about the numbers, and that is going to impact the market. Now, we were talking earlier today, like worst case scenarios when you're going aggressive, is we could get a negative initial reaction that ends up shaking out and then having a positive close by the end of the day. And so
Mhm.
with that in mind as kind of our worst case scenario, well, worst case scenario is you gap down and you keep going down. But really, in my mind, from a swing trading standpoint, the worst case scenario is really a shakeout, then that comes back up that gets you out of everything. And that happened back on May 31st. That's still fresh in my mind that, we did a lot of selling early on and then things snapped back. So what we'll do is if we get a gap down, we'll be kind of methodical about it and get rid of the worst ones first, and we'll slowly get out, just like we were slowly increasing exposure on the day after the election on that big gap up day. So that is the game plan for that reaction. And those of you trading at home, maybe you don't take the swing trader product, but what I would suggest in that case um, is if you are going to be doing a lot of selling, do a TWAP, a time weighted average price order. If your broker offers that, where it slowly sells your position or reduces your position until the closing price. That way, if it's an early shakeout during the day, you can cancel that order midday and then buy those shares back, or just sell whatever you've sold. Or if it comes back fast enough, you can buy those shares back plus some. So it just
Mhm.
really depends on how Thursday is going to play out. Um, so that is a big risk event. But this market looks perfectly set up. We're going to look at the regression lines in a little bit, but we were also talking about how Bill looked at the market and he was always saying everything was built into the market. And I wasn't going to talk about it, but it is worth discussing. He was saying with September 11th, that happened during that bear market from 2000 to 2002, that prior to the September 11th, that the market that he believed that the market knew something. And we'll never know if that's the case or not because the information does get leaked out there and people act on it, and markets either come down or go up depending on if the news is positive or negative. But that's how extreme he took that approach of everything is built into the market. So your job is to just look at charts. And that was going around in my head all day today as I was seeing this perfect setup with this risk event tomorrow, just going, we got to take a shot and we'll adjust accordingly, afterwards, and, have to pare back. But anyone who's, going aggressive, you just do have to realize that we are just taking, a lot of risk going into that event. And so you don't have to if you don't feel comfortable with it.
Mhm. And also, it's worth mentioning again. So, NVIDIA has its earnings event tomorrow after the close. So, November 20th, 2024, for those that are looking at this after the fact rather than live. So, there are some different ways in which to approach that. Right now, we have a quarter position. So, we're not really in a position to where we have to hedge that necessarily because it's not going to affect the portfolio too much. Now, uh, if we had a larger position, and I do have a larger position in my portfolio, I might
Me
I
too.
might
Yeah.
do some hedging, and a couple ways you can do that. You can either sell your position and exchange it for a call option, where you can say, okay, this is the amount that I'm willing to risk, and if the call option makes sense, yes, you're going to get a volatility crush, but at the end of the day, you're kind of making sure that you're not taking a big hit. The other thing you can do is buy a protective put. So, whether you want to do a half hedge or a full hedge, you can either buy, you know, whatever you have. You can say, okay, I'm going to buy that many contracts to cover that with a 50 delta put, and you can. That'll provide you with a half hedge. If you double it, that'll provide you with a full hedge. So again, if you have 100 shares of Nvidia, you would buy one contract of a 50 delta put, and if you wanted to do a full hedge, you would buy two contracts, so 200 shares, basically covered of the 100 shares that you have, with the put option. So those are some ways that you can go about doing this. You could also sell down your position, but for some people, look, they might have had Nvidia for a while and they really don't want to lose their position. Maybe they're looking at long-term capital gains. So there's a lot of different reasons why you might approach that differently. For us here on Swing Trader, again, because we have the quarter position, that's something that we don't necessarily need to hedge. But we wanted to kind of talk about those options with options that you have available to you, because that is something that we might do in the future. So, with that being said,
Yeah,
why don't
and
we go
I'll
ahead and
just
move?
say for
Oh,
me,
mhm,
how I had approached it is
mhm,
I have been dialing back my Nvidia position, um, my equity, and then I bought some call options. And I'm not an option expert. I don't play one on TV or on YouTube. That's for you and Chris Gessel are the option experts. I just bought some calls and then today with its action, I added to my equity, but it's still the equity side is still relatively um, small just because of the risk. But the reality is, if there's a negative reaction in NVIDIA, it's going to hit everything. If there's a positive reaction, it's going to hit everything, from almost everything. So, um, you know,
and you know what? There's a good point here made on in the comments on YouTube here, again for the live YouTube. Someone was mentioning, oh, sometimes you'll have an earnings event, and you might have good earnings and you still sell off. So here's
mhm.
Powell down 15% in after hours, and again, that's where, getting back to what you said earlier, Mike, it's the reaction sometimes that's more important than the numbers themselves. So I've said this many times. You could give me the headline ahead of time, and sometimes that wouldn't help me at all to make the right decision. That's something that the market kind of decides on its own.
Yeah, I've seen that so many times where you would just look at the numbers, like the revenue guidance, the EPS guidance, they beat numbers, everything was good, the raise guidance across the board, but there would be one metric in there
Hmm.
that the analysts really key in on, and that's the thing that causes the sell off. Or vice versa. It misses on some stuff, but then they say like it ends up being like a kitchen sink type of
Hmm.
quarter where they make the quarter look bad, but then give good guidance. So again, it just goes to the point. It's just reaction. You don't even need to really look at the numbers. You need to just, like the Powell that's down right now. Who knows what ends up happening during the conference call? Could get sell off, could intensify, or things come back. It's tricky. Earnings
And
are
we've
really
seen
hard.
plenty of reversals where something starts down, and then by the end of the day, it
Well,
doesn't
Viking,
look.
right?
Yeah, you
Vikings
know what?
are
I was just thinking about putting that up. Let me go ahead and put my market search back up and show Viking. I do have a position in Viking. This is also on leaderboard. So yeah, Viking Holdings. I mean, that was an ugly start to the day, but if we just take a look at the intraday chart, and that is something that we do a lot when we're getting hit pretty hard. Again, not necessarily earnings related, but just a hard market. A lot of times we will kind of look at that first. Uh, 5 minute bar, 10-minute bar, 15-minute bar, and say, okay, what happens? What happens there? Does it keep on going down? And in this case, leaderboard again had a position. They hedged that position, so they were kind of covered. And then once it started recovering, it was like, oh, we can take that hedge off because now we have the earnings event behind us. I'm going to go ahead and stop my share because I
Sure.
want you to be able to share, Mike. Everyone is sharing today because it's really important that we take a look at these regression channel lines. Again, we went over this on Friday before the bounce, kind of in anticipation, saying, okay, let's go through the scenarios. If if we bounce here, that's kind of the time to get aggressive. And so just in order to follow our own instructions, that's one of the reasons why we got aggressive today.
Exactly. So again, I would say everyone should watch the Friday SMT for more on this. But we're using the anchor points of August 5th, and we go out 50 days from there. So 50 trading days is October 14th. So this is where we're stopping this regression. So again, regression is just a line of best fit, and we've got some standard deviation lines around that. And so the way I like to look at regressions is once you have a nice trend established, the thought process is it wants to mean revert. It wants to go back to what I call home base or your white line. And you'll see, like with the election, you were down under here and it wanted to go right back up to that white line there. It got there and then it did this pullback. And so the triggers that I like to use is when you undercut or come down and even come close to touching the one standard deviation, which is your green solid line here. Once you get back up to the dash line, which is minus 0.75 standard deviations, that's where you gun it with the assumption that the market wants to mean revert quickly up to your white line. Again, it happened over here, it happened here, it happens a ton of times throughout history, individual stocks as well as indices. And so this is our thought process is, you know, we think it's going to go to there if there's a positive reaction. Now, there might be a negative reaction. If there is, and you go back underneath here, then we're going to have to back away. Let's also look at this on the NASDAQ because it looks a little bit different because with the NASDAQ, because it's acting stronger, this time it just barely came in and touched your 0.75 and didn't get any lower. And with today, you were able to take out the highs of that gap down from last week, and so from Friday, and so that was kind of your signal there. And another time to look at it was over here, came down to your one standard deviation. This day here was really where we wanted to gun it. We did increase exposure a lot on that day from where we were. I think ending about 40% from being just 7% in a couple of days before that because of it going back up to that 0.75 standard deviation there. And of course, it did mean revert, got up to where it normally gets up to the plus 0.75, which is this red dash line, then came back in. And let's look at it on the Qs because it's slightly different there. This one did come in, touch your, and I do have a position in the SPY and the Qs as well.
As
And
do
this
I.
one did come in to this level here, just undercut the one standard deviation a little bit. And today you decisively got back above your 0.75. So if you have an instrument that you trust and believe in, nothing is perfect, nothing is foolproof, but you want to listen to your instruments. And this is the time where I've studied and said to gun it. But then again, if we come back under here, that'll be an expectation breaker and you'll have to back away. And
Hmm.
one other thing on here that just adds to it, and this we went over on Friday, was your 50% retracement. Be very brief here, using this low here on the 31st of October, and our highs here on September or on November 11th on Veterans Day. Thank you, all your veterans, and to my father. Uh, and here you undercut your 50% retracement was 18,725, and you wanted to live back above there. And that's exactly what started happening yesterday, happened more today. And we saw the exact same thing happen with SPY. So all the evidence there is just kind of picture perfect. The levels, we got support right at the levels where we're wanting. So all of the signals that we have are telling us to go in heavy. Again, it doesn't mean it's going to work out, but you got to trust your instruments.
Hmm. Absolutely. And
I
you
can
know,
stop sharing and we can go back because otherwise I'll go on this for an hour and I know
right. But you
Dominic
know
will
what? I,
be
I think I
finished.
think an important point that you made here is that it wasn't just one level that we were looking at for support. I mean, it was multiple. The 21-day line, the 50% the 50% retracement, the regression line, the top of the area of resistance. It was just all of those. Which again, I know that you've maybe been saying picture perfect a lot, but there really were a lot of places that we were looking for that support that were all right at the same place, and the market did exactly what we wanted it to do. And again, that that doesn't always happen, right? There's plenty of times where you want the market
No,
to get support in a certain spot and it just does not cooperate. So you can't fight it when it does. You can't just say, well, I'm gonna plant my flag in the sand and wait until the market bends to my will, because believe me, I've done that and it does not work well. Let's go ahead and move on. We're going to talk a little bit about some of the areas that we're going into and that we're looking very set up. One of the areas that I think was really kind of sticking out to us today was software. I'm going to pull up IGV. This is
I
the
do have a position in that.
yeah. I don't think I have a position in this myself, but we did have this on Swing Trader previously, and this is one where we had noted this kind of setup here, and we were buying, adding, and then we started trimming up here. I think we trimmed a little bit more on this day, and then we exited completely on this day, and now here we are. We got this really beautiful upside reversal. You undercut this area, shake people out, you get support right there at 100, and then you have this outside day. This is something that happened with a lot of the indexes too. You kind of took out the highs of Friday. That was another level that we were looking at that we really wanted to see the indexes, get above, and IGV did that as well. So big outside day, really kind of made a lot of progress, and there were plenty of stocks, that were kind of looking very similar. We couldn't put them all on, so we had to choose. We went with ServiceNow, but Hubs was looking pretty good. DocuSign, Spotify. I do have a position in Spotify.
I have a
Um,
Spotify now. Yeah.
yeah, so there were a number of these software companies that had this reversal look. And there were a lot of reversals today, upside reversals, and that is kind of one of our favorite setups. So let's get back to IGV, and what do you have to add to this?
Look, I love software because their sales tend to be, in general, tend to be very consistent and high rates of growth. So 20% plus for a lot of the software names, and because it's things have reverted from back in the day when we were just kids, whereas like you would buy software, companies would buy software, a one-time thing, salespeople would come out and try to like get you to buy the new stuff, and
Hmm.
it was like pulling teeth, and so it was very hard business.
Very lumpy earnings, right? It was like, okay, great earnings when your new software came out, and then nothing until the next time. It was just cost, cost, cost.
Yeah, so now they some smart people, guys and girls, decided, hey, let's do software as a service, have it, you pay as you go type of thing. Um, and it's really helped from an investor standpoint, because then you have this kind of this idea of, okay, here's how the earnings are going to be because here's how the sales are going to be. And very, very steady. Adobe was a classic one. Uh,
Yeah, that was the
there
poster child very early on in that, back in 2012, the software as a service. Hmm.
Yeah, and they all kind of switched
Hmm.
over. You pretty much had to. It's like, the horse and buggy whip type of thing is anyone who just does a one-time software deal now. Everything is, with the cloud, and so I'm not telling anyone something they don't know. But let's look at service now and let's look at the earnings on there. Um, let's go to the weekly.
Yeah,
Um,
earning stability of
yeah,
4 with a 32% growth rate. This is why this is the one we chose, right?
yeah.
The fundamentals were just kind of too good to ignore.
Let's scroll down to the quarterly numbers for a
Mhm.
second, and look at how those are all in the, you would like it to be growing faster than the 20% on the sales, but look how steady those are. So your earnings line is super steady, like you were pointing out with the stability of the earnings line, and then the stability of the sales are there. So doesn't mean the stock can't go down. You see it's corrected in the past and it's built big bases. So that can happen again. But you on the weekly chart, this kind of looks in the spirit of a 3 weeks tight. There's two different types of 3 weeks tight. You have 3 weeks tight where the bars are tight and the closes are tight, and then you have the other ones where just the closes are tight, but the spreads are all over the place. Um, we always prefer the other version, but this is also showing that you know that tight area is a concept that Bill O'Neill came up with before we were born, of really a sign that the institutions like the stock and they're supporting it in and around a certain area. Once they get enough shares there, then they kind of push it up to the next level. So I hate to say picture perfect again, but because that's going to be my famous last words,
Mhm.
because we'll gap down, but you've got to be intellectually honest in the market is the most important thing. And if you see a setup like this, even if we gap down, I would still look at it unless there's something I missed. Just say I would do the same thing. It's just like you always like to do your kind of blackjack analogies. You know, um, if dealer's showing a 6 and you've got an 11, what are you going to do?
Right.
Well, you're going to double down. But,
Hmm.
um, or if you're playing poker, you get, pocket aces, you're going to go in heavy, right? Because that's the setup. Doesn't mean you're going to win
Hmm.
that hand, but you just got to go with your instruments.
And again, you want to put more money to work when the odds are in your favor, and
Yeah,
that's what we're trying to do. You know what? One more chart to go over, and then I also want to get to the pie chart. Um,
sure.
talk a little bit about ARK-K because this was a position that got started, and again, there's certainly a lot of chat about the risk management principles that may be lacking here, but if you want heat, and it seems like this is a market where some of the heat is a good bet right now. ARK-K does kind of provide that. So maybe talk a little bit about the decision to go with this one. Did you freeze or did I freeze? Um, so I okay. So you know what? I'm going to go ahead and take this because it looks like Mike is frozen for a second. Actually, you know what I'm going to do is I'm going to go to our pie chart and share that real quick, just so I can kind of do a comparison of where we were at and where we are right now. So let me share this. I'm going to blow this up, and you can see that, right? Okay, so here's where we were last week, and look, we had a lot of different areas in here. Our ETFs with our SPY and QLD leveraged ETFs. We had our chips with Nvidia, retail, crypto, internet, and you know what? We're pretty spread out again right now. We put on some smaller positions. We're kind of waiting to see if we're going to add to a lot of those, and then we have a lot in these general market ETFs. That's this large part here. And I should also mention that we have gone on margin. So we did scale back a little bit previously, and now we've kind of gone back on margin. So this seems like again the time to be getting a little aggressive. Um, and let me go ahead and I'm going to stop the share here.
Can you
Uh,
see me?
I can see you.
Okay, I had a
Yep,
crash.
a little
I'm
crash. It
sorry.
happens, right?
What I was
So
saying about ARC was just simply that um, it's spread out amongst the heat, and so it's a way of, if you have one stock, because a lot of the stocks that she trades are very risky, right? And that's what we're going after. Not all of them are risky because it's got some slower ones in there, but like Shopify and things that aren't like super crazy. But it's a way of spreading yourself out and just saying, okay, I want to play heat at this point. And you had brought up the IBD, the the 50, the FFTY, that looks good too right now and looks totally uh, set up, and that's another way of playing heat. It's not something I normally trade, but it is looks really good. I think it looks really good. You had that break out of that cup. Really, it was a cup with handle, then pulled back in, and you had your nice move back up right now. So that's another alternative of way of playing it. But I feel a little bit more comfortable with ARC, with the liquidity and everything
Hmm.
there. But I think the FFTY looks really good as well.
Hmm. Perfect. Well, I think that's going to wrap it up for us this week. Any final thoughts, Mike?
Just want to point out that we're both probably going to be traveling next Tuesday after
Oh,
the
thank you
close.
very much.
So we most likely will not, unless something changes with our flights
Well,
or
we're just going to
travel.
call it right now. I think just to be safe, we're going to say
Okay.
happy Thanksgiving to everybody. Because I know I'm definitely going to be on a plane, and Mike is very likely to be. So,
Yeah.
yeah, we unfortunately, as much as Chris would love to just do it all by himself, yes, we're in the office right now, and so he's giggling at me. But yeah, so we're going to go ahead and wish everyone a happy Thanksgiving. Hope you have a wonderful time with your families. I personally am going to be in Hawaii with my daughter, so she couldn't come home because she had a lab on Wednesday night. So we're going to her, and so again, have a great holiday, everyone, and thanks for watching. We'll see you in 2 weeks. Bye bye now.